they could get lots of tax dollars and good jobs out of this, and all they've done is scared capital away.
Hey guys, welcome back to the channel. Today we have Kevin O'Leary explaining why a ban on proof of work, POW, in New York will render the state uninvestable. On June 3rd, the New York State Senate passed legislation prohibiting POW mining. If passed by the governor, Kathy Hochul, the law would prohibit mining in the state and would make it difficult to renew already issued mining licenses. The discussion, which has drawn the attention of many high-profile crypto enthusiasts like Kevin O'Leary, has developed into a proxy battle over the threat that the government rules may represent to the digital currency sector. Watch to the very end to hear Kevin O'Leary's ideology on the ban of Bitcoin mining in New York and its effects on Bitcoin price and tax dollars in the state. Don't forget to comment down below what you think. Hit the like and subscribe button if you enjoy the content we do here on this channel. Let's get right through the interview with Kevin O'Leary. Amid the push to ban mining, Kevin O'Leary, a renowned millionaire investor, said the proof of work ban would scare businesses away. However, it would have no vital consequences on the price of Bitcoin whatsoever. According to the crypto bull, the state, along with California and Massachusetts, is uninvestable owing to weak management and anti-crypto regulations.
My own compliance department doesn't know what a stablecoin is yet. My auditors don't know what a stablecoin is yet because there's no policy to focus on. There's no regulatory environment. There's no regulatory infrastructure. It's not going to make a difference to the industry because Bitcoin mining will go on, but it's really bad for New York. I mean, New York has an abundance of hydroelectricity, which most miners would prefer to use than carbon burning power. They could get lots of tax dollars and good jobs out of this, and all they've done is scared capital away. I had a project that we were going to do in New York, and we moved it to Norway. And so it's a very successful, completely zero carbon emission data center. New York could have got it, but instead we took that capital and moved it to where the environment's far more friendly for business. New York is in a state of confusion, I think. People don't understand the opportunity here. But look, it's their state. They can do what they wish. But there's a reason real estate prices have gone up in Miami. It's all the people leaving New York. California, New York, and Massachusetts are examples of poorly managed states. And I don't want to pull any punches on it. I would not invest there. I would invest in places like Texas and Florida, Norway, Switzerland, United Arab Emirates, that have stable policy around digital currencies.
The Bitcoin markets are already in a state of collapse. Now New York is poised to become the first state in the US to partially prohibit some energy-intensive Bitcoin mining operations. According to data from digital currency business Foundry, New York's share of the Bitcoin mining network fell from 20% to 10% in a matter of months, as miners began to migrate to more crypto-friendly jurisdictions in other areas of the country. Proposed prohibitions on proof-of-work cryptocurrencies are becoming more prevalent for environmental reasons. In late March, the European Parliament narrowly defeated a similar proposal known as the Markets in Crypto Assets (MiCA) bill, with parliamentarians even proposing a ban on Bitcoin trade to enforce the intended ban on mining.
Now, maybe New York thinks that Bitcoin is going away. It's their purview to do that, but it is not creating jobs, it is not attracting capital, and certainly policymakers there need to do a little more work on understanding what Bitcoin mining can be for them. But right now, it's uninvestable. Imagine saying that about a state. Uninvestable.
When it comes to market trendiness, Bitcoin is all the rage these days. From celebrity endorsements to Super Bowl advertising to NFTs, cryptocurrency has been increasingly mainstream in recent years. From January $776.4 billion to December $2.3 trillion, the 2021 cryptocurrency market capitalization increased by over $1.5 trillion, nearly doubling in value. The Bitcoin industry is still worth $1.82 trillion as of March 14, 2022.
We do need regulation in my view, on a stable coin backed by the US dollar, and I'll tell you why. If you are compliant within the financial services industry, as I have to be, because this is not my only investment, I'm involved in many regulated different financial services. My own compliance department doesn't know what a stablecoin is yet. My auditors don't know what a stablecoin is yet because there's no policy to focus on. There's no regulatory environment. There's no regulatory infrastructure.
A number of stablecoins, most notably Terra USD and Tether, have previously made news for their inability to provide stability. Terra lost nearly all of its value in Tether, and the largest and most popular stablecoin shows signs of fragility. Stablecoins have become essential components of the cryptocurrency ecosystem, fulfilling critical tasks for investors and speculators. Despite confidence about Bitcoin's future, derivatives markets indicate that investors are still concerned about Ether's near-term prospects. While options markets indicate a bullish look for Bitcoin over the next month, investors anticipate challenging trading conditions for Ether over the same time period. Luna, the sibling cryptocurrency of the contentious stablecoin, Terra USD, has fallen to zero, a remarkable decline for a cryptocurrency that was once valued more than $100. The demise of the algorithmic stablecoin Terra USD has prompted concerns about the long-term viability of comparable crypto assets. Let's hear what Kevin O'Leary has to say about this.
And Luna is an experiment. An idea that you can use an algorithm to somehow support a stablecoin has proven to be a falsehood. And that's okay. That doesn't change the basic concept of what a stablecoin can be. I, as a user of stablecoins, would prefer one that is really denominated by the US dollar, and the policy that's been put forward, or at least proposed policy from the Haggerty bill and the Toomey bill, very simple. They're saying, look, let's audit this every 30 days and let's make sure that the underlying asset supporting the token or coin has a duration of less than 12 months. That makes a lot of sense to me. So I think they should put that policy in place, pass it, and let lots of stablecoins compete under that regulatory environment. Now, if you wish to invest in something that's algorithmic, that's okay. That's like going to Las Vegas. And I don't have a problem with that, but to say that something blows up that's just a speculation, well, when you put all your money on black in Las Vegas and it's red, you lose it all. That's okay. It's a form of entertainment in my view. There's no problem with what happened there, but it is not the future of what the payment system of stablecoin can be.
Stablecoins operate as transaction lubricants in DeFi marketplaces, and the collapse of Terra was viewed as a particularly severe blow to the sector's credibility. In contrast to other prominent stablecoins that claim to be backed by reserve portfolios, Terra was created to mirror the value of the US dollar through a financial link with sister token Luna. Analysts believe Ether's decline reflects how the Terra and Luna crashes have sent shivers through the entire DeFi market, because many of the computerized financial apps in the decentralized market are built on the Ethereum blockchain, where Ether lives. The token price is linked to investors' hopes for the future of DeFi. Even with the huge crash of Luna coin price, does Luna still have some juice in it to rise in the nearest future? Please leave your thoughts in the comment section below, and don't forget to like and subscribe. We'll see you in the next video.